The global semiconductor shortage showed the world just how vital these tiny chips are to our modern economy. But beyond the current headlines, we're seeing a structural, long-term shift that makes this sector one of the most compelling for investors. With the rise of artificial intelligence, 5G, and the Internet of Things, demand for advanced chips is only set to explode. So, how can you position your portfolio to benefit? In this video, we'll do a deep dive into the best semiconductor stocks to consider now. We'll analyze the key players, from established giants to innovative disruptors, and break down the latest ratings, price targets, and insights from Wall Street's top analysts. Taiwan Semiconductor Manufacturing Company Limited, ticker TSMC. Taiwan Semiconductor is the world's leading and most dedicated pure-play semiconductor foundry, a business model it pioneered in 1987. Instead of designing and selling its own chips, TSMC manufactures semiconductor wafers for a global clientele of fabless companies and integrated device manufacturers, IDMs. This allows its customers, which include major technology firms like Apple, Nvidia, and Qualcomm, to focus on chip design while leveraging TSMC's advanced manufacturing capabilities. The company is renowned for its relentless pursuit of cutting-edge process technology, consistently being at the forefront of nodes like 7N, 5N, and 3N, which are critical for powering everything from smartphones and high-performance computing to automotive and IoT devices. As a foundational pillar of the global technology supply chain, TSMC's business is characterized by massive capital investment in R&D and state-of-the-art fabrication facilities to maintain its technological leadership and manufacturing scale. From the smartphone in your hand to the car you drive and the AI models reshaping our world, there's one company that powers them all. It's not Intel, and it's not Nvidia. It's the unseen giant, Taiwan Semiconductor Manufacturing Company, or TSMC. The company isn't just growing, it's on an absolute tear. In 2024, revenue skyrocketed by nearly 34% year-over-year. But even more impressive are the profit margins. We're talking about a gross margin above 56% and a net profit margin over 40%. For a manufacturing company, that's almost unheard of. It shows incredible pricing power and efficiency. And this momentum isn't slowing down. Their most recent Q3 2025 results show revenue up over 30% and net income surging 39%. Why? One phrase: booming AI chip demand. TSMC is printing money, and it's sitting on a massive war chest of over 2 trillion Taiwan dollars in cash to fund its future. So, what's fueling this growth? TSMC is perfectly positioned at the center of every major tech trend. Artificial intelligence. This is the big one. The AI revolution runs on advanced semiconductors, and TSMC manufactures the most complex chips for industry leaders. AI-related revenue is expected to make up over a quarter of their sales by 2030. Electric and autonomous vehicles. Cars are becoming computers on wheels, and they all need chips. 5G and the Internet of Things. More connected devices mean more demand for TSMC's foundational technology. The overall wafer foundry market is projected to grow 20% annually in 2025, and TSMC, as the leader, is set to capture a huge piece of that pie. Now, let's flip the coin. Because with TSMC, the risks are as massive as the opportunities. You can't talk about this stock without addressing the elephant in the room: geopolitical risk. TSMC's most advanced fabs are located in Taiwan. Ongoing U.S.-China tensions and the potential for cross-strait conflict pose an existential threat that could disrupt the entire global tech supply chain. This is, without a doubt, the single biggest risk for any TSMC investor. Fierce competition. Their technology lead is being challenged. Both Intel and Samsung are aggressively chasing their 2-nanometer technology. If they succeed, they could erode their pricing power and market share. Rising costs. Building chip fabs is incredibly expensive. TSMC's expansions overseas, like in Arizona, are facing higher costs for labor, energy, and materials, which could squeeze those fantastic margins in the future. So where does this leave us as investors? As of October 2025, the stock is trading around $298, with a PE ratio of about 33. That's not cheap, but it reflects its premium market-leading status. Technically, it's trading above its 50-day moving average, showing near-term strength. The verdict from Wall Street on TSMC is not just positive, it's overwhelmingly confident. Right now, the consensus rating for TSMC is a resounding strong buy. Let's look at the numbers. Between 72% to 80% of analysts are issuing a buy or strong buy recommendation. Major firms like Needham & Company and Barclays have recently reiterated their buy ratings. And here's a key point. There are virtually no sell ratings to be found. The analyst community is firmly in the bull camp. So, why are they so optimistic? It all boils down to three key factors. Dominant technology. TSMC isn't just a player, it's the leader in manufacturing the world's most advanced chips. They're years ahead of the competition. The AI boom. The massive demand for artificial intelligence chips is a direct tailwind for TSMC. They are the primary manufacturer for the brains behind AI. Strong financials. Their recent Q3 earnings were powerful, demonstrating that their technological edge is translating directly into financial performance. But what does that mean for its potential price? This is where it gets exciting for investors. The current stock price is hovering around $298 per share. Now, look at the average analyst price target. The consensus points to a price target between $360 and $372 per share. Do the math. That implies a potential upside of roughly 20 to 26% from today's levels. That's a significant growth projection. Firms like Needham have a $360 price target, and Barclays raised theirs to $355. This isn't just hopeful thinking. It's a calculated forecast based on TSMC's growth trajectory and its pivotal role in the tech ecosystem. While the long-term view is spectacularly bright, some analysts point to near-term clouds on the horizon. The most notable caution comes from Zacks Investment Research, which currently has a hold rating on TSMC. This isn't a reason to panic, but it is a crucial reminder to be a smart investor. The strong buy case is for the long haul, but the journey may have some volatility. So, what's the final takeaway? The analyst community overwhelmingly endorses TSMC as a strong buy with a clear path for solid price appreciation, backed by its unrivaled technology and the AI megatrend. However, they also advise investors to be aware of the short-term risks, namely geopolitics and costs. Micron Technology, ticker MU. Micron Technology is a global leader in the semiconductor industry, specializing in the development and manufacturing of memory and storage solutions. Its core product portfolio includes dynamic random access memory, or DRAM, NAND flash memory, and solid-state drives, or SSDs, which are essential components in a vast array of computing devices. These products are critical for data centers, personal computers, smartphones, networking systems, and a growing number of applications in the automotive and embedded electronics sectors. As one of the few companies in the world capable of high-volume production of both DRAM and NAND, Micron plays a pivotal role in the global supply chain, driving innovation to meet the escalating demands for higher performance and greater data capacity across the technology landscape. If you've been watching the chip space, you've seen Micron stocks soar, trading near all-time highs around $220. But is this rally justified? And more importantly, does it still have room to run? Let's break down the numbers, the opportunities, and the very real risks. First, the financials are nothing short of spectacular. For fiscal 2025, Micron reported a record revenue of $37.38 billion, a massive 49% year-over-year increase.
Their net income came in at a staggering $8.54 billion, with adjusted earnings per share of $8.29. The fourth quarter was even more impressive, with revenue of $11.32 billion and a powerful adjusted EPS of $3.03. This performance is generating serious cash, with operating cash flow surging to $5.73 billion in Q4 alone. Simply put, Micron is not just growing, it's highly profitable. So, what's driving this incredible performance? One acronym: AI. Micron is a direct and major beneficiary of the AI revolution. The key drivers are high bandwidth memory, or HBM. This is the specialized, ultra-fast memory that AI servers crave. Micron's HBM revenue is on an incredible trajectory, expected to reach an $8 billion annual run rate. This is a secular, long-term tailwind, not a short-term blip. Market leadership. As one of the major US-based memory manufacturers, Micron has a unique advantage. Customers, especially government and cloud providers, are prioritizing geographic diversity in their supply chains, and that benefits Micron. Explosive margins. The company's gross margins are already robust, near 40%, but guidance points to them climbing over 50%. This means more profit drops directly to the bottom line with every additional dollar of AI-related sales.
Now, before we get too excited, we must address the risks. Investing in memory chips has never been a smooth ride, and Micron faces some significant challenges. The cyclicality trap. The memory market is famously cyclical. We're currently in a massive upswing, but history tells us a downturn in demand and pricing is inevitable. The question is not if, but when. Supply chain and competition. Scaling HBM production is difficult. There are potential bottlenecks in advanced packaging. Meanwhile, competitors like SK Hynix are not standing still. They're aggressively expanding their own capacity. Geopolitics and CapEx. US-China trade tensions remain a persistent risk. Furthermore, this business is capital-intensive. Micron invested $13.8 billion in FY 2025. This heavy spending is necessary to stay competitive, but weighs on free cash flow. Macro risks. A global economic slowdown or volatility in interest rates could dampen the very data center investments that are powering this growth. Micron Technology is in a position of incredible financial strength, perfectly positioned to capitalize on the AI-driven memory boom. The growth in HBM is a game changer that could help smooth out some of its historical cyclicality. However, this is not a risk-free investment. The stock's high PE ratio of around 29 prices in a lot of this perfection. Investors need to have a strong stomach for potential volatility and keep a close eye on industry cycles and competitive dynamics. Overall, Micron presents a compelling, though high-stakes opportunity for those looking to bet on the foundational technology of AI. The analyst consensus on Micron is solidly positive. Out of roughly 30 to 35 analysts covering the stock, a significant majority, anywhere from 62% to over 80%, are recommending it as a buy or strong buy. Here's the key takeaway. There are currently no sell ratings. That's a powerful vote of confidence from the professional analyst community. Firms like Zacks and data aggregators like TipRanks and MarketBeat all place MU in the buy category, highlighting its strong growth and momentum.
Now, let's look at some specific recent moves. This is where the story gets a bit more nuanced. Morgan Stanley recently raised its price target to $220, which is right around where the stock is trading today. However, they maintained an equal weight or a hold rating. They see the value but are cautious on near-term upside. On the more bullish side, we have Citigroup and Barclays with buy or overweight ratings and targets ranging from $150 on the lower end all the way up to $240. And the current bull on the street appears to be BNP Paribas Exane, who assigned an outperform rating with a street high price target of $270. So with all this positivity, what's the catch? It comes down to the average price target. When you blend all these analyst projections together, the average 12-month price target sits between $193 and $213. With MU's current price hovering around $220, this math suggests the stock might be fairly valued or even slightly overvalued in the very near term. The massive upside, according to the average, might already be priced in for now. So why are analysts still so bullish if the short-term price targets seem limited? The answer lies in the long-term story. Analysts universally view Micron as a primary beneficiary of the artificial intelligence revolution. AI servers need vast amounts of high-performance memory, and Micron is a leader in that space. They're seeing strong fundamentals, with earnings and revenues surprising to the upside. The recommendation isn't based on a quick pop next week, but on a belief in the company's growth trajectory over the next few years. If you're looking for a quick, short-term trade, the data suggests you might be buying at a peak. The risk is that the stock consolidates or pulls back as it waits for its earnings to grow into its current valuation. However, if you're a long-term investor who believes in the AI-driven demand for memory, the analyst community is giving you a clear green light. Micron is viewed as a strong buy with fantastic industry tailwinds. The strategy here would be to consider buying on any market-related dips or weakness rather than chasing the price at all-time highs.
Nvidia Corporation, ticker NVDA. Nvidia Corporation is a dominant American technology company renowned for pioneering the graphics processing unit and is now a leader in visual computing and artificial intelligence. Initially famous for powering high-performance graphics in gaming and professional markets, its scope has dramatically expanded. Today, Nvidia's core business revolves around designing and selling two primary categories of accelerated computing platforms: its foundational GPU chips and its comprehensive full-stack software and system solutions. These are critical for a wide range of transformative technologies, including AI computing, data science, autonomous vehicles, robotics, and the industrial metaverse. While its GeForce GPUs remain a powerhouse in the gaming industry, its data center platform, featuring products like the H100 GPU and the DGX systems, has become its largest and fastest-growing market segment, fueling complex AI models and high-performance computing workloads for enterprises and cloud providers worldwide. As of late 2025, Nvidia is trading around $191 per share, commanding a massive $4.65 trillion market cap. The reason for that valuation becomes clear when you look at its growth. Over the last 12 months, Nvidia has generated a whopping $165 billion in revenue, which is up an incredible 71% year over year. But it's not just about top-line growth, it's about profitability. Nvidia turns a huge portion of that revenue into pure profit, with a net profit margin of over 52%. That means for every dollar of sales, more than 50 cents ends up as net income. To put that in perspective, their net income for the last year was $86.6 billion. This financial strength gives them a massive war chest. With free cash flow of $72 billion, Nvidia has the resources to invest heavily in research, development, and strategic acquisitions to stay ahead of the curve. So where is all this growth coming from? The story is almost entirely about one thing: the data center segment. This unit, which includes their flagship AI GPUs, now accounts for a dominant 88% of total revenue. The demand for AI processing power from cloud giants and enterprises shows no signs of slowing down, and Nvidia is the undisputed king of this market.
Beyond the data center, the company is planting flags in future markets. Their Nvidia Drive platform for autonomous vehicles and their expansion into edge computing represent significant long-term growth opportunities that could become major revenue streams down the line. This is why analyst sentiment remains largely positive. While the stock isn't a secret, many see continued upside with near-term price targets around $211 and bullish long-term projections based on the multi-trillion-dollar AI opportunity. However, no investment is without risk, and for Nvidia, the risks are as substantial as its opportunities. First and foremost is concentration risk. With nearly 90% of revenue tied to the data center and AI, Any slowdown in that specific sector could hit Nvidia disproportionately hard. Then there's competition. Rivals like AMD are chasing them aggressively, and perhaps more worryingly, their biggest customers like Google, Amazon, and Microsoft are all developing their own in-house AI chips, which could eventually erode Nvidia's market share and pricing power. Geopolitics is another major factor. U.S. restrictions on chip exports to China limit access to a huge market, creating a persistent headwind for revenue growth. And we can't ignore the supply chain. Nvidia relies on partners like TSMC to manufacture its most advanced chips. Any disruption there could lead to production bottlenecks. And finally, and perhaps most critically for new investors, is the valuation. With a PE ratio of 53, the stock is priced for absolute perfection. This creates significant downside risk if the company merely meets expectations instead of smashing them, or if there's a broader market shift away from high-growth tech.
The message from Wall Street is loud and clear. Out of the nearly 50 analysts covering Nvidia, the overwhelming consensus is a strong buy. The average price target sits between $211 and $222 per share. That implies a solid 10 to 19% upside from current levels. But that's just the average. The real excitement comes from the most bullish analysts on the street. Some have set price targets as high as $275, even $320 per share. That represents a potential gain of 60 to 70% from here. These analysts believe Nvidia's market cap could soar towards a staggering $7 to $8 trillion in the coming years, all on the back of the unstoppable growth of AI. What's your take on Nvidia? A surefire winner or too expensive to touch? Let me know in the comments below. Thanks for watching, and don't forget to subscribe for more deep dives.